Good morning, everyone, and welcome. I think we're all connecting now. Thank you so much for joining us today to this session. My name is Raquel Lorenzo. I'm the Golden Visa Program lead at Palo Ventures, and I'll be hosting this session for you. Before we begin, just a couple of housekeeping things. So this session is being now recorded, and hopefully we're going to share the video, the recording with you. We will have some time for questions at the end of the session. So please feel free to send all your questions, comments, and we will go through it in the end. And most importantly, the purpose of this session is educational, to provide some guidance. This should not be considered any legal or tax advice. Your circumstances may be different, so we do recommend before you take any decision to talk to an advisor, and I'll be more than happy to connect you with one of our speakers if you feel like. Um, and just starting, let me just to go through the agenda. We know most of you are probably considering applying for the Golden Visa. Maybe some have already done it. The idea of today is not going through the detail of the application, but instead provide you first some legal updates. There's been some discussion on legislation that might change in Portugal, and we want to give you more information on that. And the most important part is we're going to provide you some tax guidance, both in Portugal, the country where you would be doing your investment, but also in the US, as most of you probably are from the US or based here. With us for that, we have the honor to count with amazing experts from Portugal, from our partner in Portugal, Legal Square. We have Pedro Marques Monteiro, is the head of Foreign Investment and Immigration Department, and also André Pinho, head of Tax Department. They have a lot of experience advising investors on the Portuguese Golden Visa program, and they will provide all the information today in the session. And from the US, also our partner, Tony Osauto, is a CPA and partner at Catalano Cabur Company, and he specializes in providing tax management, accounting, and management consulting services to high net worth individuals. So I think we're going to be in very, very good hands, and hopefully this is going to be very insightful for all of you. Before we move on, in case someone is not yet familiar with the program and its benefits, um, I would like to just highlight the fact that the Portuguese program is still one of the most attractive in Europe, mostly because it doesn't require relocation. So if you still need to be based in your home country in the US, you can pretty much do everything from distance. It only requires you to spend 7 days the first year, which is like a vacation, and then 14 days in the next 2 years. This is usually one of the benefits most investors will appreciate. And then there are other benefits like being able to travel, to be able to travel in the Schengen area, which includes more than 29 countries, to be able to include your family, partner, or kids into one application and into your application with just one investment. And of course, having access to the Portuguese market and benefits like healthcare access, or also access to the education system. In order to apply, actually, you just need to make sure you don't have a European nationality, which probably you don't, because otherwise you wouldn't be interested. Should have a clean criminal record, and most importantly, you should be willing to. I got a message. Oh, there's this. I don't know how to remove this. Is it bothering you? This.
It's gone now.
It's gone? Okay, I
Oh,
think it's only comes when I'm changing slides. Sorry about that. But as I was saying, and the most important, in order to apply for the Golden Visa, you should make a minimum investment of €500,000 in one of the eligible funds. And this is why the Palo Ventures is here. So we are a Chicago-based VC fund that invests in early stage startups in the hard tech space. Either technologies or innovations in the manufacturing sector, or end products for consumers, but that at least brings some disruptive innovation into the energy space, climate, and also we invest in AI. We are already operating in the US. We have a fund. We invested in 14 companies. These are very early stage, high potential, high growth companies. We invest them when the capital is critical for them to grow and eventually exit and be acquired. And in this process, we came across Heat Capital. They are equity management firm in Portugal. Has been I've been operating in the market for a long time. And they have a couple of Golden Visa funds and supported more than 300 applicants to the process. And together, the two companies decided that it would be a very good idea to bring into the market an opportunity, give the investors the opportunity to invest in the VC and at the same time be able to apply for the Golden Visa. So we launched the Dipalo Heat Fund. I hope you see well my slides. It's a 20 million euro fund that we aim to raise, a 10-year term, close-ended, to invest, as I said, in early stage startups. 60% of the investment is going to be done in Portugal and 40% in the US. So there's still some exposure to the American market, which is very appreciated also for some of our investments. And it offers investors a 20% IRR net of fees, which is quite competitive and attractive as an investment. But because we know not all funds and not all investors actually might be comfortable with the risk that this kind of funds have, we decided to bundle two funds. The Dipalo Heat Fund, the VC, and allow you to invest in the startup space with the Heat Top Fund, which is managed by Heat Capital, and it's a fund focused on equity and bonds. More conservative, gives you preservation of capital, but also gives you 5% of IRR. This will give you diversification on your investment, the ability to tailor your risk reward profile based on what you feel comfortable with. You're still dealing with the same fund manager, the same team. So if you like us, if you trust us, you have here two options. Usually, if you want to switch funds, you need to work with different companies, which is not the case here. And we think this could be very interesting as an investor if you want to apply for the Golden Visa. My introduction to our funds and services is very brief because it's not the main focus of this session, but I'm happy to share more information after the session and of course have a one-to-one call with anyone interested in our investment opportunities. So now I'll leave it, the floor is yours, Pedro, to go through the application and the legal updates in Portugal.
Sure. Thank you so much, Raquel. Hello, everyone. It's a pleasure to be here. So as Raquel already mentioned, the Portuguese Golden Visa program is one of the most successful programs of its kind and the most successful in Europe, for sure. And it offers the possibility of having a European residency that leads to a possible citizenship passport application in case, of course, the applicants follow some of the requirements. The most important, of course, is the 5 years of residency that they need to spend in Portugal, not spend, obtain, sorry, spend in Portugal, because in order to obtain those 5 years, one of the main requirements and one of the biggest selling points of the program is the 7 days per year stay requirement. So it's a very low stay requirement, just a week every year. The applicants will be able to renew the residencies until they reach the 5-year level, and at the time they can then apply for permanent residency or citizenship in Portugal. Of course, the citizenship option is the most popular. In order to do all this, the first step is making a qualifiable investment, an investment of 500,000 euros. That's the minimum threshold in a private equity fund, the Paulo Ventures here. And once this investment is done, then the second step is submit the application. The application is divided into two main steps. One, an online application. We need to gather a few documents from each applicant, passport copy, criminal record, and then if there is family members to join, there are some family members like spouse, kids, parents, and parents-in-law. We need a bunch of other documents that are required, like criminal records, marriage certificates, birth certificates, things like that. It's important to note that among the applicants that can join the main applicant, of course, spouse and kids, but also kids above 18 years old, as long as they are students and not married, and also the parents and parents in law, as long as they are 65 years old or more. Okay, so with one single investment, the main applicant can bring the nuclear family to Portugal or benefiting from the residency in Portugal. Of course, this program does not require them to move or relocate to Portugal, since the stay requirement is only 7 days per year. But everyone can benefit from the residency, and then everyone can apply for the Portuguese passport. As you can see in the board, the last step, step 4, is residency that after 5 years leads to a possible citizenship application. And in a nutshell, this is what the program entails. Of course, during the first 5 years, the applicants can also benefit from free travel in all Schengen countries, and of course, access any public services in Portugal, such as the public healthcare, which is for free and is the 12th best healthcare service in the world, and also free education and all the other services and amenities that Portugal offers. Of course, not only the sun and the food that is good, we have some more things to offer. And that's it in a nutshell. I believe we can pass to the second slide, where we will discuss recent discussion that is basically ongoing in Portugal about some changes in the law. So what I just explained is the law right now. The law is 5 years since the inception of the program that was created in 2012. All the changes were in favor of the applicants, meaning when the program started, 6 years were required. Sorry, to spend in Portugal to get residence in Portugal. Sorry, not spend. To obtain the citizenship application to be able to apply. That was reduced to 5 in 2017, if I'm not mistaken. But then nowadays, in 2026, the discussion is to raise a little bit the requirements in terms of the timeline needed to apply for passport. It's important to note two things. First, the Golden Visa program is not changing. The nationality law is, and that may impact the timeline for the passport application, but the Golden Visa program itself is not changing, meaning you only need to keep the investment for 5 years, and that will not change, even if this law changes. Again, this law is being negotiated, but it's not entirely certain that it will change, okay? But there are discussions ongoing in the parliament since last year. And so it's important to note that. And it's important to note that the Golden Visa program remains the same. 5 years needed as the investment wise in terms of the time the applicants need to hold the investment. Also, minimum, I mean. Also, that is important to note that after 5 years, it's possible to apply for a permanent residency in Portugal. So they can have, worst case scenario, if it's 10 years of the timeline to apply for the citizenship, all the applicants can reach that level by having a permanent residency in Portugal, which they are entitled to. And that permanent residency for Golden Visa applicants, there is a special regime where they don't need to live in Portugal, be tax residents whatsoever. So the system is exactly the same as the Golden Visa in terms of stay requirement, in terms of tax requirements, which is almost none, if, of course, the applicants do not relocate to Portugal. I mean, living in Portugal for 6 months a year at least. And so this is very important to note. The changes are mostly two. One, the government wants to raise the timeline from the minimum 5 years to apply for citizenship to 10 years, and wants to change the counting system that is now, or the days the residency timeline is counted from the day the applicants apply for the visa, and the government wants to change for the old system, pre-2024, it was like this. So the timeline is counted from the day the applicants receive the first residency card. For sake of timeline information, the first residency card takes about 1 year to be obtained. So this means that the Golden Visa application timeline would be more or less 6 years and not 5 because of the counting system, if it changes, okay? And this is very important to note. I mean, in a nutshell, that's the information I want to give you today. And then, of course, we can discuss further in the Q&A.
So now we'll go to the tax part and the tax obligations in Portugal. And the key thing to understand is that there are basically two different statuses as to what relates to tax in Portugal. You can either be a tax resident or a non-tax resident. And this is connected to your physical presence in Portugal. If you are a person which resides in Portugal, spends here most of their time, then you must register as a tax resident. And or if you don't, and if you spend less than half of the year in Portugal, then you must register as a non-tax resident. And this has very big implications on how you will be taxed in Portugal. If you are a non-tax resident, then you are not taxed in the country unless you generate income which is based in Portugal. So let's say that you rent a property here and you are generating rental income, then in that case, you do need to submit a tax report in Portugal where you will declare only that Portuguese income, none other. If, on the other hand, you start residing here and you move to Portugal, then you must report your worldwide income and may be taxed on it, in which case the double taxation agreements that Portugal has with other countries will enter into force. So it is also important to notice that this kind of funds, these venture capital funds, which work for Golden Visa, they are under a special tax regime in Portugal, which exempts non-tax residents of taxation and any reporting. The reporting is actually done by the fund. So if you are an investor which invests in a Portuguese fund such as this one, and you receive dividends, these will not be subject to tax in Portugal, and there will be no reporting needed, even though you are actually generating income in the country. On the other, again, this is always with the idea that you are not residing here and that you have not moved to Portugal. If you do move to the country, then in that case you need to report your worldwide income and not only your Portuguese income. So the idea that you wanted to pass here is that your reporting obligations and your tax obligations are actually quite simple through this route if you don't move to the country. Also important to notice that even though you do need to, as a Portuguese tax resident, you do need to report your worldwide income, foreign assets do not need to be reported, and they are not taxed. Portuguese has a tax legislation based on income generated, not assets.
Thank you, Andrea. I think you finished,
This is
right?
from my side.
Yes, and we're gonna move on now to the U.S. considerations. Tony, it's all yours.
Thank you, Raquel. Good morning or afternoon, everyone. Thank you, depending on where you are. I'm going to cover briefly here the tax considerations in the U.S. Thank you, Andre, for pointing out and the tax treatment in Portugal. And we do have a tax treaty with Portugal, and it allows us to have some better tax results in general. But here's some brief topics I want to cover, and we'll go over a few of them and some details there. I want to talk in general about the taxation foreign fund investments, some reporting requirements, the anti-deferral regimes consisting of what we call PFICs or passive foreign investment companies and CFCs, controlled foreign corps. We'll talk a little bit about the importance of entity classification and some indirect ownership, and also investing through a self-directed IRA, if that's a possibility. And then there's some elections to help offset some of the potential negatives of this previous anti-deferral regimes, the QEF, which is a qualified electing fund, and a mark-to-market elections. If we can move to the next slide, Raquel. So in general, under the overall U.S. taxation of foreign fund investments, it's important to understand as a U.S. citizen, just like someone who's a citizen of Portugal, as a U.S. citizen, you're taxed on your worldwide income. And that means the income from this fund is going to be taxable to you in the U.S. And if there was a tax in Portugal, there would have been, under the treaty, an opportunity to claim a foreign tax credit and help reduce the impact of any potential double taxation. But because there's no foreign taxes being paid because of the preferential taxing regime of this fund, it's simply, we don't have to mess with that detail. We won't have to take a foreign tax credit in order to offset or minimize our potential for double taxation. So the concept of, oh, I'm going to move my fund to some tax haven is all about just tax deferral. You're still taxed on your worldwide income no matter where it comes from. So that means all gains, income, distributions from foreign funds are also have some special reporting requirements on them. And again, if you do happen to be double taxed because as a U.S. citizen you're recognizing your worldwide income, there's foreign tax credit opportunities to offset or minimize that double taxation effect. And then a lot of the tax treatment here depends on the structure of the fund and the U.S. classification of that fund. You could move to the next slide, Raquel. So some of the general reporting requirements that many investing overseas may already be familiar with. First, we have what's called FBARs, the foreign bank account reporting. And anytime you have signature authority over an account that has a balance of over $10,000, you're supposed to report that information on your U.S. tax return. A more expanded version of that, the IRS came out with several years ago, is under the Foreign Account Tax Compliance Act, and it's a form 8938, I'm sorry, and that's required if you have investments that exceed generally $100,000. So in this case, as an investor in a DH fund, you would be reporting this information on an 8938. There's no extra tax, it's just a reporting thing. And then there's a form 8621, which happens to be involved with this whole special tax regime of these PFICs, or passive foreign investment companies, and we'll get to that in a moment. And if you happen to be doing this through a CFC, there's a form 5471. This is all about reporting what should be your share of the income from these types of entities and not being able to defer that income and still recognize it in the US, which is under the basic principles that all income, your worldwide income, is taxed. You move to the next slide. So what the government is concerned about when it comes to foreign investments is you deferring your income by creating an overseas corporation, for example, earning the dividends in that corporation and deferring the U.S. tax on that till you get it back. So they've come up with all these complicated rules to ensure that you don't defer your income, and they're basically referred to as anti-deferral regimes, and they consist of these two main types of entities. So if you invest in something that is actually a passive foreign investment company, or PFIC for short, they have some ways of taxing you currently, even though you're not getting the income yet, and you might be in a low taxed or no taxed tax haven, so to speak. In this case, we've got this special treatment where there's no tax on that income in Portugal, but you're still going to pay tax on that in the US. If the fund is structured such that it is considered a PFIC, then you may be taxed at the highest tax rate and also have some deferred interest for having an excess deferral. It's all part of this, what they call excess distributions, or gains being taxed at ordinary income plus interest on the amount of deferred tax. So this is, for example, what happen if you invest in the fund and you get no distributions or anything for 4 years, and then all of it comes out in the 5th year. What they would do is that would be excess distributions, and you'd go back, and all of your income would be ordinary income tax at the highest rates, and they'd add an interest charge on there as well. Not a very favorable tax result in the U.S. So we will talk about how to get out of that PFIC scenario for you near the end of this. If you happen to be investing in a direct corporation and you own more than 50%, then the CFC rules come into play, but I don't believe that's our scenario here. You're just basically going to be concerned with this first part, which is PFIC. Next slide, please. So it's also important to note that the type of entity that you are, and the indirect ownership that you have needs to be looked at because it really depends on the type of entity classification that the investment is. As a corporation, you might be subject to the CFC rules. As a partnership, it's going to be a look-through rule. So U.S. investors in a Portuguese LLC owning PFIC stock is really an indirect PFIC shareholder. And so the important part there is that you're still subject to these PFIC rules, and you'll want to make some elections and the applicable reporting on that. So, you have to look at how the thing is structured, which just simply determines how you go about making elections and taking advantage of some of the preferential elections. Next slide, please. Investing through self, a lot of people are doing this, investing through their IRAs. It has to be a self-directed IRA, which has all sorts of qualifications. Most trustees in the U.S., like typical banks and things like that, they have policies against doing this. So you have to find a specific trustee that's willing to have a self-directed IRA and allows investments in real estate and in foreign companies and venture capital. But the thing to point out here is there's some things to be concerned with. If the fund generates unrelated business taxable income, or if the IRA invests in a company that has what they call unrelated business taxable income, then your IRA may be required to file its own tax return and pay some tax on that income. There's reporting requirements. It's a 990T. And while IRAs in general are all tax deferred in the U.S., this would be a carve out of that, and some of that income would be identified, and you would have to pay some current tax on that. The good news is that the PFIC rules don't apply in an IRA. So the IRS has come out and said that shareholders under Section 1231 are not treated as PFIC shareholders if it's held through an IRA. So there's a little bit of relief there, but that at the same time, you have this and have to be concerned with and aware of the unrelated business taxable income. I don't know that any of the investments are anticipated to generate any unrelated business taxable income, but I don't know the full answer to that now. Next slide, please. So what are the two elections we're talking about here that help minimize the negative impact of a PFIC? There's two out there, QEF, or Qualified Electing Fund, and then a market elections. There are two different types of elections, both attempting to avoid this excess distribution and extra tax by essentially electing to include currently the income of the investment now, as opposed to trying to defer it. So the first one, QEF, Qualifying Electing Fund, pretty much avoids the excess distribution regime that happens under a PFIC. You make that election and you recognize the earnings every year, and they retain the character of those earnings, and it's pretty much treated like it was a pass-through entity, and the income of the PFIC is simply reported on your personal return via special form. Then there's a mark-to-market. It's only available for PFIC stock that's actually marketable and publicly traded. However, the annual income on that is based on the fair market value increase and not actually the income. So you're going to be paying tax potentially on income that hasn't been realized yet, and any decreases in fair market values up to previous increases can be taken as ordinary losses. This also avoids the excess distribution regime, but it's not quite as favorable as the QEF. If you can qualify for the QEF, that would be the preferable method of taking an election to accelerate and recognize the earnings of what would otherwise have been deferred if the entity is a passive foreign investment company. Both require an annual Form 8621. That information comes from the fund. and you make that election on your personal return every year. In the case of a QEF, you make that the first year, and I believe it has to be filed every year, as with the mark-to-market. Do we have another slide there?
I don't think so.
Okay. Well, that concludes mine, and I'll of course be available for questions. Thank you.
Thank you, Tony. Yes, so we do have some minutes for questions. This is your opportunity now to share everything on the chat. Especially, I would say Andrea might leave earlier. So if you have anything regarding Portugal, do share it now. In the meantime, just to let you know, so the Paulo Ventures here for you and also our network of partners, as you can see, we're surrounded by really great people, experts in their fields. We're here to help you and guide you on your decision. Happy to have one-to-one calls, provide more details on the application, on the investment, and also help you analyze your personal situation and see what is best for you. So we're gonna be in touch with you, but feel free to reach out and ask for those one-to-one calls. So for now, I'll stop sharing the screen and
Raquel, you have one question on the chat.
yeah, this is what I'm about to check and read for everyone. So I have here a question. Once a Golden Visa holder applies for the permanent resident card, in year 5, assuming the citizenship law changes the wait requirement to 10 years, what will be the minimum stay requirements once one becomes a permanent resident up until becoming a citizen? I think that's for you, Pedro. You're muted, by the way.
Sorry, my word was blocked. Yes, it's for me. So yeah, great question. What happens? There is two types of permanent residencies in Portugal. The regular permanent residency, where of course people need to relocate, spend more than 6 months a year in Portugal, become tax resident in the country, etc. And then there is a special regime designed, of course, only for Golden Visa applicants. We call it the Golden Permanent Residency, which basically in terms of stay requirement is the same as the golden visa. Actually, it's not. Actually, the 5 years, the law does not require one single day in the country. We, as lawyers in Portugal, recommend that the applicants spend 35 days across the 5-year period, just as a matter of complying with the same requirements as the golden visa. Despite that fact, the law in fact, does not require the applicant to spend one single day during the permanent residency for golden visa purposes. Okay, that's what exactly the law says. And you don't need also to have an investment in Portugal at the time or have any residency, any property or so to be able to benefit from the PR. So what basically happens in case this law passes, and it's a 10-year timeline, is that it adds another 5 years of waiting to the queue, but that's it in terms of requirements, traveling, etc. Taxes, no other requirements on your end as an applicant.
Great, thank you, Pedro. We have another question. Who handles getting a PFIC and how does that work? Does the fund do that for me? Is it just one time or every year? Is there a fee for getting a PFIC? And will the recording be shared? So that's an easy one. Yes, it will be shared with you by email. As regarding to the PFIC, yes, the fund provides the PFIC for you. No fees for that. But regarding how often this has to be done, Tony, maybe here you can help us.
Yeah, as I mentioned, I believe both the QEF qualifying electing fund option and the mark-to-market are something you would report every year via the 8621 information that the fund provides as a PFIC. There's nothing that the U.S. investor, it's not really, you don't decide whether the entity is a PFIC. It either is or it isn't based on the qualifications of a PFIC, or qualification is the wrong word because it's generally considered a negative thing, but whether it becomes a PFIC because it has more 75% or more of its income from passive sources, or 50% or more of its assets from investment nature assets, which is totally expected, which is why the fund's going to be providing the information to complete the 8621. And that's where you make your election every year on your tax return.
Thank you, Tony. There's another question. I will read for everyone. There are two different numbers mentioned for Golden Visa. One is the 200,000 euros minimum investment into heat fund, and the other was the $500,000. I think it's euros. What you mean? Which one is it in which cases? Is the case that the 200K provides entry into the fund, but needs to be increased to $500,000 to qualify for the Golden Visa. So yes, so the first number and the most important, to qualify for the Golden Visa, you must make an investment of €500,000 into a fund in Portugal, one or more than one fund. Okay, so each fund has a minimum investment that varies. And what we said today is we are offering you the opportunity to invest in one of our funds or in both funds, and each one has a different minimum investment. And you need at least to comply with that. You need to invest the minimum, but make sure all your investments sum the $500,000 so you qualify for the Golden Visa. I think that was clear. Rafik, feel free to add any information.
Yeah, sure. Hey, everyone. It's Rafik Ahmed, managing partner at DiPaolo Ventures. Thanks for joining. Yeah, the two funds, the minimum for the DiPaolo Heat or the VC fund is 200K, as Raquel mentioned. Heat top is 100K. You need a minimum of 500 to get your Golden Visa process started with law firms such as Pedro and Andres. So you can't just invest 300K and wait to top it up. I mean, you could, but that's a non-Golden Visa investment. So we encourage you to put the 500 in and decide whether to go, 50-50 between the funds or pick one or the other, etc. We prefer to bundle it, but that's a separate sort of asset management discussion. Hope that's clear, Samir.
Yeah, I hope so. That too. We have another question. If we invest in the two funds, is that two PFICs?
That's a good question, and I'm not sure. Either way,
It is. It is. They're two separate funds. They would generate two separate
each
people.
one would generate its 8621 information. Is that right, Rafik?
That's correct. They're two separate investments.
Yeah.
That's why if you want to ease, this is a good point where for ease of sort of accounting and management, one fund, one house may make more sense than splitting your 500K between even different fund managers. The one advantage of the two funds together, it's managed by Heat Top. Both of them are, it's managed by Heat Capital. So you have the same sort of back end operations, the same style, etc. So you can expect the same thing from both funds.
Thank you, Rafik. We're reaching the end of the session. Happy to answer one more question if there are any. Otherwise, you still can email us with your questions. So, yeah, doesn't seem we have any other questions. So thank you.
do have if we could just take a couple more minutes. So I do have a question for Tony based on some of the great detail he provided. So Tony, in this situation where you get a PFIC from a Portugal fund or two, as the case may be, as far as I understand, the funds would issue them at the beginning of the calendar year and in time for say the April 15th US taxes generally. Otherwise, you may have to take an extension like you do with K1s coming from various investments that we make here. The two elections between mark to market and the QEF, when does the investor need to do that? During the filing, or is this something that needs to be approved of and qualified for before tax time?
No, they can both be made with the filing of the tax return, including extensions. So in the U.S., if you extend your return till October 15th, then you can file the 8621, make your election as late as October 15th with the filing of the tax return. Nothing has to be done separate from the tax return or earlier than the filing of the tax return.
And in your opinion, the bottom line, I think for anyone as an investor would be not to have to pay ordinary income tax in the US for unrealized paper gains in a foreign fund.
Yeah, that's generally preferable.
So which of the two options, allows us to do that?
Yeah, the QEF election is more favorable in terms of that investment strategy and the looking towards longer term growth, because otherwise you're paying tax on unrealized gain under the mark to market. So the QEF would only be taxed on the actual earnings that the PFIC would have, and not just the unrealized earnings. So in general, the QEF is a better option.
And one last thing, I've had this question asked offline to me by investors, where the nature of the investments made by the foreign fund would impact this, right? So in a venture capital scenario, as in DiPaolo Heat Fund, we expect distributions upon exit. There are no dividends, there's no ordinary income, there's no earned interest. In Heat Top, it's a fund that would have stocks and bonds, and there may be dividends and interest. So, do you want to comment on sort of like the ramifications for taxes between those two types of investments?
Well, just in general, whenever you're making that financial decision, the taxes are just one element of it, and you want to look at the after-tax impact. So if you're investing in one fund that's generating more tax at a different rate, you're going to want to look at your after-tax rate of return. It's kind of the same analysis you do with deciding to invest in something that pays taxable interest and dividends, or a tax-exempt bond. You're like, well, isn't it always better to have no tax? Well, not necessarily if the rate of return is a lot lower. So you always want to take your after-tax rate of return. So in general, I can't really answer that question other than to tell you how to take a look at it, which is always look at your after-tax rate of return. If the one fund after taxes is going to yield a greater percentage of return than the other fund after taxes, then you kind of have your answer. And ultimately, it's the growth and eventual recognition of the appreciation and gain, which generally is a favorable tax rate. So, in general U.S. strategy is pay as little tax as late as possible is the general rule. So, and then if you do have to pay tax, pay it at the lowest tax rate. So that's kind of where your longer term growth, and you kind of look at that and go, okay, well, the strategy is there's no current taxation, there's no current income to be taxed, and then I'm going to have this large growth and sell it off, and that's how I'm going to realize my financial gain, and that'll be at a preferential rate, and I will have pushed off some of that taxes, as late as possible. That said, you're going to want to do the QEF on these things. Otherwise, you're going to be taxed at the highest rate. So you always want to do the QEF or the mark to market. And then beyond that, it's taking a look at both the combination of rate of return and the tax associated with that to determine your after-tax rate of return. Does that help out, Rafiq, or did I confuse it more?
No, that's great. We'll have to go back and decipher what you just said, but I think I get it.
All right.
Thanks.
Thank you. I think we're good, Rafiq, right? Do you have any other question?
No,
Yeah.
that was it.
Okay, just to be respectful with everyone's time, I think we're good to end. Thank you so much to our speakers. It was really insightful. Thank you so much for everyone who joined. And we're gonna be reaching out soon with contact details, presentation, and also this recording. Take care, everyone, and I hope you make a good decision. Thank
See you
you.
soon.
Bye.
Thank you. Bye.
Bye.